We've been there. It's 3 in the morning. You're staring at a chart of a coin named after Japanese dog or a tech stock that hasn't turned a profit since the Obama administration, and you think this is revolutionary financial instrument. Fast forward 48 hours and you realize you weren't an early adopter. You were just the exit liquidity for a guy wearing a bathrobe in Dubai. Welcome to TradingBits X. This channel is all about decoding the economy from the ground up. No noise, just sing. Today we're talking about speculation. That magical moment when markets stop reflecting math and start reflecting group hallucinations. Let's figure out why your brains betray you right when the stakes are so high. The question for today is simple. Why do smart people, engineers, doctors, hedge fund managers keep making the same catastrophic decision when the herd start running? Before we dive in, drop a comments below. What is the most insane price action you ever witnessed where you just knew reality had left the building? I'm reading all of them. What speculation really is? Speculation isn't just investing with risk. It's a specific psychology state where the price of an asset completely detaches from its utility. You aren't buying the cash flow anymore. You're buying a graded full theory. You bet that someone else will be more optimistic or more desperate than you are tomorrow. This creates a feedback loop where the story becomes more valuable than the software. When logic loses the fight against emotion, the numbers on the screen stop being money and start being a scoreboard for a game that has no rules. Excess optimism, the new paradigm. The first stage of the trap is excess optimism. This is when probabilities turn into certainty. People stop saying it might go up and start saying it has to go up. In this phase, bad news is threatened as a buying opportunity and skeptics are threatened like they are stuck in the Stone Age. You'll hear the 4 most dangerous words in finance. Time is different. The old valuation model doesn't apply to AI. DeFis make banks obsolete overnight. Real estate only goes up because they are making more land. When you hear people talking about new paradigm, check your poll. Usually it's just the old paradigm wearing a more expensive suit. Dominant narrative, the storytelling machine. Markets don't move on data, they move on narrative. A narrative is a simple story that justifies a complex price move. If the story is good enough, people will ignore the fact that the company is burning $100 million a month. Think about the crypto cycle. In 2017, ICOs are the new stock market. 2021, MTF are the new R-Wall. 2024, meme coins are the new social network. Smart people get trapped here because intelligence makes you better at rationalizations. A smart person can write a 50-page white paper explaining why a Ponzi scheme is actually a liquid staking ecosystem. Do you think high IQ makes you more or less likely to fall for a speculation bubble? Let's do the debate in the comments below. The herd effect, why we follow. We're social primates. In the wild, if the rest of the tribe start running, you don't stop to ask for a PowerPoint presentation on why, you just run. In the markets, this translates to social proof. Validation is a drug. When your neighbor makes 500% on a random tech stock, your brain processes that a threat to your social stand. This is FOMO, fear of missing out. You don't join the herd because you're stupid. You join because the psychology pain of being left behind is literally processed in the same part of the brain as physical pain. Bubble and the autonomy of the crash. Every bubble follows the same script. A stealth phase. The smart money enters quietly. Awareness. The institutional money joins. Mania. Your Uber drivers tell you what to buy. Blow off top. Price goes vertical. And denial. The healthy pullback. A bubble is fragile because it's held up by new buyers, not real value. Once you run out of the greater fool, the whole structure collapses. This is where the smart people who join the herd get slaughtered because they thought they could outrun the crowd to the exit. Spoiler, the door is very small and everyone is trying to fit through it at once. correction, the return of reality. A correction is just the market way of saying enough with the fairy tale. It's a violent return to the mean. This is where we separate conviction from momentum. If you bought because of a chart, you sell when the chart breaks. If you bought because of a narrative, you sell when the narrative changes. Only those who understand the fundamentals, reality survive correction. In crypto, this is the crypto winter. In stock is the bear market. It's painful, but it's necessary to watch out junk. So what's the lesson? Don't confuse a bull market for brain. Just because everyone is making money doesn't mean the market is healthy. It usually means it's becoming vulnerable. The smart investors aren't the ones who catch every pump. They are the ones who know when the crowd has lost its mind. If this helps you to see through the noise, share this video with one friend who is currently all in on a high train. You might save his portfolio. But understanding the crowd is only half of the battle. In our next video, we're going even deeper into the two emotions that actually control your entry and exit: fear and greed. I'm going to show you how to use the fear and greed index to time your move while everyone else is panicking. I'll see you on the next one. Stay rational and remember, money, markets, we're trading the future. See you in the next one.